Hello, my name's Craig Erlam, Senior Market Analyst at OANDA. Today we're going to talk about the euro versus the US dollar. This is a pair that's been in consolidation now for quite some time. We had the floor around that 111 level, but we were seeing lower highs building on each and every rally. The one obvious example where this wasn't the case was actually the most recent rally, which caused a little bit of confusion here. We broke through that descending trend line. We made the new high above the previous high and gave hope to some of the bulls who thought that we were about to see a period of dollar weakness. Unfortunately, that has drastically shifted really over the past couple of weeks. Two factors really feeding into that. One, the expectation that we're going to see a lot more easing from the European Central Bank. And two, the impression that we're not quite getting the response from the Federal Reserve that the markets are aggressively pricing in. And that was really came to the fore yesterday evening. We heard from the Federal Reserve. They cut interest rates for the first time in a decade. Since 2008 was the last rate cuts, obviously after the financial crisis. But they only cut by 25 basis points. That was pretty much priced in. There were some who were expecting a bit more, but I think that was unrealistic. The key thing yesterday was always going to be about the messaging. Is the Fed going to commit to more rate cuts in the near term? Is this the start of a rate cutting cycle? And how aggressive are they going to be? And again, the market's pretty aggressively priced in. Well, the Fed had other things in mind. Jay Powell suggesting that this is effectively a mid-cycle correction, suggesting that we're not in a easing mode per se at this moment in time. He also did specify that this does not mean this is a one and done scenario. There may be another cut or another couple of cuts to follow, but he doesn't want to give the impression that we're now in easing mode. The markets were not impressed. The equity markets fell off. The dollar immediately strengthened, and in this current case, the euro dollar dropped below 111 and really did pick up some speed after that. Given that this has held for so long, we did just see that move exacerbated by the fact that this had been such a long-standing support. Now we're heading back towards those 110 levels. 110, historically, it has been an area of support and resistance, but it hasn't been an overly reliable one as much as some others. But the fact that it is a big psychological level, I do expect it could potentially play a role this time. That's why we've highlighted it in red, not just because of how it's reacted previously, just because of what it actually stands for. Below there, we've got around 108.50, 109, which has been a much more clear area of support and resistance previously than the 110s. So these are the two real areas down below now that I think we're keeping a very close eye on. The difficulty for the markets right now is, though, we may see some Fed commentary. We will see some Fed commentary over the next month, but we are now into the summer period. It's going to be a lot quieter. We're not going to get another meeting now until September. Some people are already looking past that, again looking to call a Fed's bluff, again predicting another rate cut, still pricing in another 50 basis points of cuts this year. I still feel like they may be disappointed, but there's plenty of time for the Fed to continue to correct these expectations and ease the markets into what it wants to do, whereas at the moment the Fed is the markets are in full bluff mode. And what that means is this near-term disappointment because of the quiet period until the Fed starts to act, we could in fact see a little bit more dollar strengthening because of the worry that is set in as a result of those comments. Of course, if Fed policymakers now come out and try to massage the message from Powell and suggest that there is still scope for one or two more cuts this year, then the markets may be put more at ease. That may take some of the heat off this dollar rally at this moment in time. But until we start to get that message, we may see that panic just continue to lift the US dollar and potentially weigh on this currency pair. Of course, there's other factors at mind that we need to focus on right now. US earnings season is more than halfway through. It's going relatively well relative to expectations. Trade talks between the US and China is, of course, a key factor as well. Those are ticking along, although again expectations are still very low. And then there's the euro factor as well. The data which we're seeing right now is very poor. We've had more manufacturing PMIs out today, and the revisions were quite small, but they confirm the fact that we are very much in contraction territory, deep in contraction territory when we're looking at the euro and its largest component, Germany. So major causes for concern there. Scope for big ECB easing. Of course, they don't have as much room on interest rates, but QE looks to be the favoured option if they can just tidy up some of the structural issues which were called into question previously, which was one of the reasons why it was always going to be difficult to continue the QE programme when it started tapering. Again, looking at this pair, the break of that 111 level is significant. If we can break 110, then 108.50, 109 starts to look really interesting below.